Well, welcome everyone. I think we'll make a start. It's just very close to midday, and we'll start promptly. We'll just let a few more people sign on. The numbers are ticking up as we're speaking, but it's just gone 12 o'clock, so let's make a start. Hopefully you can hear us well. We'd like to welcome you to the Sabre Dawson Financial Reporting Update. My name is Peter Shields. It's been great to get everyone online and be able to give you an update. There's a fair bit happening in relation to financial reporting, so we're going to run through some of the things focused on 30 June reporters. I'd like to introduce you to Jeff Tolk, one of our partners here at Sabre Dawson, an expert in financial reporting, working with the Accounting Standard Board on a number of issues and giving feedback in relation to new developments. So he's right up to date in relation to giving you the changes that are important to know. I'd also like to introduce Edward Jones. Edward Jones, one of our senior managers and a specialist in financial reporting as well. Ed and myself are going to turn our screens off shortly, and we're going to answer questions in the background. So as we're going, if you have the option, we're going to try and mute everyone, but turn your microphones off. Feel free to have your cameras off as well. If you've got a question, just pop it into the chat box or the Q&A area there. Ed and I will answer as many as we can, go through as we can online, and then we'll come back at the very end and we'll try and answer some questions as we can as well there. So I'm going to hand over to Jeff, and thanks for dialing in. So over to you, Jeff.
Yeah, thanks a lot, Peter, and welcome everyone. Hoping one day that we'll be able to run one of these sessions in our office again and get to see you all. Or see some of you, but we are committed to continue to run them online as well. We welcome those people, particularly from interstate, and we know a number of you find this convenient. So we're committed to this format also. So today I'm going to run through a financial reporting update, including what's happening in the sector and in and around financial reporting. This is both from a for-profit and not-for-profit perspective, where I'll try and highlight where I'm talking about for-profits only or where I'm talking about not-for-profits only. Although some of the examples might seem like a for-profit example or not-for-profit example, they're actually interchangeable in a lot of cases. So please don't think if I'm talking about a grant that necessarily just means a not-for-profit. It's also for-profit context often as well. So I will, but yeah, I'll endeavour to do that. Again, so here's the agenda for today. So I'm going to take you through some of the regulatory developments, a bit about special purpose reporting and where that's at, and that's a moving target at the moment, but I'll bring you right up to date with exactly where the AASB is at with that. A little bit on the ACNC best practice. It's only a couple of minutes. I'll talk about the key standards that are causing concern, need to be rethought or considered. Primarily revenue and leases, which I know we've talked about a lot before, but this is from a post-implementation perspective, I guess. And then go through some simplified disclosure and standard there, and also COVID. So really appreciate your questions. Edward and Pete can answer those. So again, thank you for your attendance. So you already met us, and I am just going to segue slightly. So this is a little bit of advertising, so bear with me for 30 seconds. Throughout the last year, Sabre Dawson's continued to grow. Obviously helped a lot of organisations with JobKeeper and a number of other of their requirements. And so we're continuing to recruit. So if you are someone in the profession, or you have children or family members or friends that are studying accounting, commerce, that sort of thing, or have finished their degree and working in the profession, and they're looking to work with a firm like ours, potentially, we'd love to hear from you. So that includes cadets, so that might include Year 12 students about to go into uni or partly completed a uni course, graduates. We're happy to have a mid-year or end-of-year start, and also experienced staff. If someone out there knows of someone who wants to move on from an existing firm and is looking for something a bit different. So if that's any of you, please reach out to one of us or through the website as well. We'd love to have a chat with anyone who's interested in that sort of career. All right, enough of firm stuff, and I'll kick right into regulatory developments. So the first one, just want to talk about the Corps Act. And so this is for PTY companies, typically for-profit companies. So the reporting thresholds changed in 1 July 2019, and that was a doubling of the thresholds. So you're now large if you meet 2 or more of the criteria, being greater than $50 million of consolidated revenue, greater than $25 million of gross assets, so gross assets, not net assets, or more than 100 FTE employees. So if you meet 2 or more of the, or 2, all of the 3 criteria, you are large from a Corporations Act perspective. Large means you must lodge your financial reports with ASIC at the end of each year, and those reports must be audited also, unless there's certain reliefs available, but typically that would be a requirement for large. I want to highlight that as this is really important as we talk about special purpose and reporting going forward. If you're in that category, you need to listen up to those topics as I go through. In relation to what ASIC has done in relation to COVID relief, I just would note that there are some lodgement deadline relief, an AGM requirement relief, so the ability to have those online if you have AGMs and those sort of things. There's a lot of detail up on ASIC's website around COVID relief and their relief or response to some of the difficulties in compliance because of COVID and the various shutdowns. So if you're struggling with that, think you're not going to meet a deadline or whatever, or planning AGMs, have a quick look at that ASIC guidance, or email one of us in relation to that, and we can point you in the right direction. Now I just want to step out of the for-profits back into the not-for-profit area. So I just want to touch on the ACNC and what's happening there. So this is for charities, registered charities with the ACNC. So as some of you would be aware, the ACNC came in around 2013. There was a 5-year scheduled review of the legislation, and that was done in 2018, and the report was tabled. There were 30 recommendations in relation to that, that were various ones. I'm only going to talk about the ones that really relate to financial reporting, not-for-profits, financial reporting and those type of issues. It took the government a fair while to get around to actually even responding to that review, so they released a response in March, and I'm just going to update you on those key matters as to where those responses ended up. So first of all, there's a category called basic religious charity. Basic religious charity, typically an unincorporated entity with the purpose of advancing religion. Basic religious charities had a number of exemptions in the ACNC Act, both from lodgement of financial reports, audit of those financial reports, and the governance standards that also apply to the ACNC. There was a number of recommendations and submissions saying the BRC category shouldn't exist, in effect, and that should be removed. The government response is they have no plans to remove that exemption. And so if you're a BRC, I think you've got a fair amount of certainty that you can continue on the assumption that those exemptions will stay in place, at least for, I would suggest, the current government. And while that government is maintained of the current persuasion, I don't expect any movement there. Potentially change of government that could alter, but at the moment, I think you're relatively safe in that, in assuming those exemptions will apply. The second, one of the second major recommendations out of the review was a change in the thresholds, or an uplifting of the thresholds. Government have now responded to that. They've got a different and a bit lower than what was proposed in the legislative review, but these are the new or proposed thresholds. And Treasury has put out, so this is a legislated part of the Act, and so Treasury puts out any changes in legislation. So Treasury is in consultation, and I think that's just about finished, that consultation period. But their proposed thresholds are to be small, which is very little reporting requirements, just basically your AIS, that category moves from below revenue of $250,000 to revenue of $500,000. The medium category, and this is important, listen up if you're in these categories, some of this impacts what is happening around the special purpose removal project. So the medium category is proposed to be revenue of between $500,000 and $3 million. At the moment, that means if you're a medium category, you're currently between 250 and $1 million. So that uplift, an extension of that category, you can have a review performed instead of an audit, and you still have to lodge your financial reports. But again, I'll talk more about that medium category in a little while. That leaves the large category. So everyone above $3 million would be considered large, and you would be required lodge financial reports audited by a registered company auditor, compliance with the governance standards, and any other requirements. I would note that although Treasury is in consultation around that, they are committed to actually working with the states and territories to ensure that they don't change the thresholds in the ACNC Act without also, hopefully, getting the other states and territories on board. So for incorporated associations that are also charities, for example, that the states adopt the same thresholds, which means that you can still report once to the ACNC and cover your state obligations as well through that. And so the timing of this really depends on how keen the states and territories are to engage in this process. Obviously, the Corps Act would also be changed, but given that's a federal legislation, again, controlled by Treasury in effect, I don't expect there to be delays because of that, but it did take a fair while to the states to get on board the first time. So it may take a year or two, I think, for this actually to come about. The next main change, or the third main change that we see, is there was a recommendation that related party disclosures, including key management personnel, so that's just senior executive type team within an organisation, that related party disclosures and executive or key management personnel remuneration is disclosed within the financial report, and that's really a requirement of the accounting standard AASB 124. Government has supported this. They are thinking about sort of minimising some certain disclosures around for smaller type entities. And this would actually be a reasonably easy change to make. You can make it in the regs, not go through a Treasury consultation process. However, they've also committed this recommendation to changes to the regulations, but the start date will align with the revenue thresholds. So again, something that would be easy to implement and could have done, I thought they might do it first. They're saying, no, they're going to do it all in one go as and when those thresholds get changed. Just briefly touch on if you're an incorporated association and also a charity, that the transitional provisions, which in effect allowed you to continue to report as though under the state requirements, and the ACNC would accept that, they are pretty much gone unless you're from Queensland. So you do need to comply with the accounting standards, the minimum accounting standards that the ACNC Act and regulations have in them, and you also must be audited by a registered company auditor if you're from any states other than Queensland. I would also point out that we are finally seeing some good movement in relation to fundraising reforms, particularly WASA and VIC. I would note not in New South Wales and Queensland as yet. From my perspective, I guess from financial reporting and some of those sort of perspectives, WA and New South Wales were probably the most onerous from that perspective. So we've seen some movement in WA. New South Wales still has their reporting requirements within reporting financial reports, etc. All right. So that's really the update from a regulator perspective. I'm going to jump into special purpose reporting and give you an update there. By way of background, first of all, so in Australia, financial reporting, we really have, I guess, divided into two streams. General purpose reporting, and that means compliance with accounting standards in effect. So do you comply with all the accounting standards you are a general purpose reporter. And that means you're following all the rules for recognition, measurement of transactions and balances, as well as disclosure requirements. There is a subset of general purpose reporting, which is called RDR, or reduced disclosure requirements, takes out a whole lot of the disclosures that are really designed for large financial institutions, insurance companies, listed companies, etc. So general purpose is a given and is here to stay. Special purpose is a little bit unique. A lot of other countries have special purpose, and it allows you to have limited application of the accounting standards, Australian accounting standards. And you really get to choose your own policies. Obviously, for a charity, for example, you must comply with certain standards, but it's pretty wide. That obviously has issues with it, in that if everyone's preparing financial reports on the same basis, they're probably more comparable, they're more transparent. Some people would argue they're more understandable. Whereas special purpose, you could be designing your own unique accounting policies, and it can be more difficult for a reader of the financial report to understand exactly what you've done in relation to your transactions and balances. So the question is, how long special purpose here for? And the answer is, it's not here indefinitely. So I'll update you with exactly where that's up. So in early 2020, an accounting standard was issued that really changed a number of areas of legislation and those reporting under the Corps Act. But basically, in practice, what it did was remove special purpose for for-profit entities. So if you're a for-profit entity, proprietary limited company, think of that large category that I talked about before, so required to report under the Corps Act. Your ability to prepare special purpose financial reports is gone as of 1 July 2021. So if you're 30 June year end, you can still report special purpose this year, but that's it. So what does that mean? You really need to be thinking about and understanding what recognition and measurement, so that's that R&M thing on the bottom of that slide, what recognition and measurement rules are you following or are you applying in your accounts? Are you following all the rules in the accounting standard? Typical ones where that doesn't occur is tax effect accounting, which can become quite complex. Leases, so the new lease standard, some organisations didn't like it, understandably. I understand why, and chose not to adopt that at that time. Also, consolidation is a really big issue. So where you've got subsidiaries, and I'm going to touch on it a little bit more in a moment, but where you have those type of entities, you will need to consider if you need to consolidate financial reports and lodge consolidated reports with ASIC, and also do full related party disclosures. In private companies, often organisations don't want to disclose where they've got related party transactions with owners and those sort of things. So those disclosures will come in as of 1 July 2021. So your June 2022 financial report, or December 2022 if there's any for-profit December year ends on the line today. Just a couple of things on consolidation. So consolidation goes beyond, or the requirement to consolidate is beyond simply a traditional parent entity, subsidiary entity, own 100% of the shares type relationship, which is what we typically think of when we say, does one entity control another? So it's not just about shareholding in a company. It can also include things like service trusts, or where you've got special purpose vehicles, unit trusts, other entities that may be not 100% owned, but maybe 50% owned, or in some cases less than 50% owned, could result in consolidation. Similarly, if you own between 20 and 50%, equity accounting type issues come about. So if you have those types of organisations, or there's any doubt around, is this associated entity or entity that we deal with, could it be considered to be controlled? Please have a chat to us around that. Happy to engage with us. It's really important you understand what do you need to do for 2022 around consolidation. it can be a significant uplift in the requirement in relation to those other entities. The second one is related parties. As I mentioned, a lot of organisations private companies don't like including related party disclosures. It's none of your business attitude, I guess, and again, understand that. But you will need to disclose nature and amounts of transactions with related parties, including key management personnel remuneration disclosures. So they will be that's an aggregate disclosure. So it's sort of a $1 value, which might be the wage and benefits of 3 or 5 people within the organisation, but still those disclosures are going to be required, which is different to those things haven't really been in the accounts and on the public record before. So that's the for-profits. I'll now jump into the not-for-profit space. As you would understand, when I talked about the thresholds and even the increase in thresholds, the thresholds for not-for-profits and charities, incorporated associations are far lower than they are for the for-profits. And so it's quite common for many not-for-profits to be reporting on a more simplified basis, utilising special purpose. And so the AASB recognised that actually there's probably a bit more work to be done around special purpose removal for not-for-profits, particularly at the smaller end. That being said, they are currently actively engaged in a project for removal of special purpose with an aim to have what's proposed and what the mechanisms are, how smaller entities might get some exemptions or what we're going to do with them by the end of 2022, so 18 months away. That's when we should start to see what's the AASB really proposing, thinking around this, and proposals out beyond consultation, but actually draft standards starting to be released, etc. They would then have a couple of years time frame for application to give time for organisations to get ready. So they still aim to be effective from 2024 or 2025 year ends is what the current project is. So there are proposals, or the current thinking, and they've moved quite quickly down this path, so I don't expect it to change, is the current proposal is that they want to develop what would be, they're calling Tier 3 proposed standard. And that would be for organisations like charities with that in that medium category. So this $500 to $3 million turnover threshold should be available for these. So this is in the early stages of development and consultation, but it is actively being pursued down this pathway. What does it mean? It means very similar things as it does to the for-profit space. So recognition and measurement. What are you currently doing versus what would the standards require you to do if that's different? Oh no, I think I've frozen, but hopefully you can still hear me. Oh, I'm moving again, that's okay. Secondly, it would mean consolidation, and the tests for control in not-for-profits are a bit different to a for-profit arrangement. So you can have control even where there isn't a shareholding arrangement or where there isn't ability to receive the net. My internet is kicking a little bit slow, so I'm just going to stop my video for a moment, but I will keep talking if that's okay. I'm hoping you can still hear me.
We've got you coming through loud and clear here, Jeff. So
oh, okay. Thank you. Sorry, I can see myself pausing and in the screen on the side. I'll just
pause.
Peter will jump in if we have serious problems. We tried to spread out to ensure we had a about. So just a bit more detail around some of those. So what does Tier 3 look like? So again, that revenue, 500 to 1,000 to 3 million. Simplified accounting standards, likely to include things like potentially simplified revenue recognition. Understand there was a new revenue standard not that long ago, but it is cumbersome to work with, and I understand that. Likewise, leases, so there's certainly may not get adopted at that simplified level. So for those of you who haven't adopted, I would say hang out where you are, don't apply yet. Let's see, particularly in this $500,000 to $3 million threshold, let's see what happens with this third tier. It's likely that it'll be one standard. So New Zealand has one standard. It's pretty basic. It's difficult to use where there's some complexity in that. Pete, can you just tell me if you can still hear me or not?
Yeah, we're still hearing you. Just a little bit of break up there, Jeff, but we've still got you okay.
Okay, thank you. So it's still likely, it will likely be one standard. That one standard doesn't deal particularly well with complex scenarios. They've really cut down the standard, put in the basic concepts or principles, but not a lot of guidance around, well, what happens when we're a bit different to that? So it has its problems, but that is likely the way it will go. And we're not sure what they'll do with consolidation. There's certainly some consideration of whether consolidation will be exempted at that smaller area. Oh, sorry, that smaller end, or that tier 3. So that's where that is at the moment. I just want to talk to you around some additional not-for-profit disclosures that really were a lead-in to the removal of special purpose. So these were effective for 30 June 2020. So last year, hopefully in your accounts, you would have seen some of these. If you're an ASIC, ACNC or ASIC lodger, a not-for-profit lodger, you had to include where your special purpose, whether or not you complied with the recognition and measurement requirements of the accounting standards, and if you didn't, what you did. And secondly, do you have any subsidiaries or controlled entities that you haven't consolidated or that you haven't made that assessment yet? So there are a couple of disclosures that I think were designed primarily to get organisations thinking about what does it mean for the removal of special purpose, as well as users of the financial statements being able to understand what has an entity actually done, and is there more behind the scenes in effect that I should think about? And that was right up the front of note 1 in most set of accounts. So if you didn't do that, that is a mandatory disclosure for ACNC or ASIC lodgers. So please check your templates or make sure you include those disclosures in the current period. So special purpose, I've given you a fair bit of information, try and then move to, well, what do you really need to do? So special purpose is a choice by boards that there's no users of the financial or users relying on the financial statements or that they get the information they need through the special purpose accounts. So we would suggest that the board actually confirms that every year. We have a template around that if you want to be quite formal in that, but certainly as you adopt accounts that are special purpose, that I believe it's important that the board acknowledges and understands what that means. With the removal of special purpose, I think it's important that the boards begin to understand what accounting standards have you not complied with and what impact would that have going forward, as well as the secondary one is, do you have any potential subsidiaries or controlled entities? And again, what would the impact be around having to consolidate potentially equity account, if it's an associate, those entities? And there is some strategies here. So again, we're talking, I've been talking directly with AASB around the consolidation standard, and is it really the right tests around control for not-for-profits? So we're continuing, and some of our clients have got concerns around this, so we're continuing to try and advocate on your behalf around that. So there is some potential that the consolidation standard and the rules around consolidation not-for-profits could change as at the same time as they remove special purpose. But if that's not the case, or even if those new rules don't really make sense to you, or you think that it's not appropriate to consolidate, there is some strategies around removing that link of control. So that might be changing the constitutions of an entity, how board members are selected, those sort of things. So there is some things to think about as we move through if you're really concerned about the consolidation of other entities and your own. All right, I'm going to touch briefly on some best practice guidance that the ACNC issued. So this is relatively recent. So the ACNC have released a guidance, or what they're calling a best practice guide. I would note there wasn't a lot of consultation on this. This is the ACNC view of perhaps what best practice is. It doesn't align with what the accounting standards say are the minimum disclosures. It may not be your view of what's helpful disclosures for users. And so I would just emphasize that it's a guide. It's not mandatory. You don't have to adopt it. But if you consider that you think it's useful or you want to comply with what the regulator is saying is better practice, here's what it really is requiring. So they believe, or the ACNC believes, that the amount of government funding and where that funding comes from should be more transparent in financial reports. Often disclosures would just be government grants, or maybe federal government grants, state government grants, and not a lot of disaggregation beyond that. So the guide suggests that there's a total revenue line by each government, each level of government, so state, federal, local, and the names of the various government departments that you got funding from. So that might be, if you get a lot of government grants, a lot of government funding, that'll be a significant amount of increase in disaggregation of those disclosures. And also where that revenue that might come from government is actually in relation to providing goods or services. So typically we see that disability, where it's a fee-for-service model, aged care sort of fee-for-service models, or some of the social services models are really a fee-for-service activity. So where it's that type of funding also. In addition, where you have unearned income, so grants received in advance, income received in advance, those sort of things, that disclosure is disaggregated again to show how much relates to government versus how much is non-government income in advance. In addition, this is the disclosure that probably used to be around 10 years ago. It got removed from the accounting standards, probably dropped out of a lot of set of accounts, but again, something that's been described as better practice by the ACNC is this old economic dependency note. So where a charity is dependent on government for a significant revenue or financial report, saying that the charity really should. I will keep going. So thank you. Again, apologies for that dropout. So I'm just going to jump in and share now around what we're seeing around AASB 15, AASB 16 leases, and then talk a little bit about simplified disclosures. But this is really, as I said before, a bit of post-implementation and what we're seeing around lessons learned. So AASB 15 revenue, both for-profits, not-for-profits, have adopted in the last 2 years, and just want to highlight some of the areas we think where we're seeing our clients, but broadly what we're hearing across the all organisations is where you can do this a little bit better, and some of the underlying principles that need to be thought about perhaps a little bit further by some organisations. So the principle of AASB 15 is you recognise revenue that shows the transfer of goods to the customer. So it's no longer about whether you fulfilled you think you've got no further obligations, etc. It's about the customer receiving goods, services, or benefit in relation to whatever you're providing. So you can't just assume that you recognise revenue as your costs are incurred. That percentage of completion type calculation left the building when AASB 15 arrived. I just want to remind you of the 5-step model, which we know we've talked about before, and talks about identifying a contract, then identifying your performance obligations. If you have a contract with a customer, what are your performance obligations, promises, the things you need to do under that contract to earn your revenue or receive your revenue? It then talks about transaction price, allocating that transaction price, and then you recognise your revenue as you fulfil your performance obligations or your promises or your obligations under that agreement. So we see a lot of agreements with milestone payments. I just want to reiterate that a milestone payment may not have any correlation whatsoever to you satisfying your obligations and the customer receiving the benefit or receiving those goods and services. Okay, it might be that you're able to negotiate payment up front or payment along the way, even though the customer doesn't receive the benefit until the end. And so you can't assume that the milestone payment equals you satisfying performance obligations in all circumstances. It may, but it certainly isn't a given. To jump into performance obligations, so there's a couple of limbs to performance obligations. So the customer must be able to benefit, either receive the good or service and use them. All the good or service is separately identifiable from others. So it might receive part, there might be many goods or services or a number of goods or services promised under the agreement, and the customer receives them at different times. So that's what equals a performance obligation. You need to consider and document when you are satisfying, because that results in the revenue being recognised. So you need to really understand, well, what are these obligations? When does the customer receive them? And that is what you link your revenue recognition to. There's many contracts, probably more in the not-for-profit space than the for-profit space, but certainly in the for-profit space as well, where a customer actually receives the goods or services or benefits over time. So as time passes, or as you do a number of things under an agreement, the customer gets the benefit. So where that's the case, where a customer controls the asset as it's created, or receives or consumes the benefits as you perform your obligations, you get over to this box here, which is control is transferred over time. This enables you to recognise revenue over a period of time or as you go in fulfilling the contract. If you can't answer yes to any of these questions, they're the two most common though. If you can't get to control over time, you have control transferred at a point in time, or your performance obligations satisfied at a point in time, typically at the end, and so therefore you don't get to recognise your revenue until the end. And so that's very different to that old percentage of completion method that we talked about before. So again, just want to reiterate, it's about the customer receiving the benefit, not your cost or effort. I would note that where control is only passed, or you only satisfy your obligations at the end, that does mean you don't get to recognise revenue. However, the direct costs associated with you developing an asset, or building a service, or providing something that the customer benefits on gets the benefit from at the end, you get to capitalise those costs and have work in progress on your balance sheet in effect. So this does actually implement a whole lot of uncertainty and a whole lot of variability into the profit and loss, both in the revenue and potentially the expense side, particularly if that sort of wage is being capitalised and those sort of things. So it brings, I guess, an inventory concept into the space of revenue recognition, whereas before that was very obvious around only goods that physical type goods where you'd have inventory on a balance sheet. So work in progress is becoming more common on balance sheets because of this standard. When you do have control being transferred over time, or control over time, there's two methods, available methods for understanding, well, how do I measure how much revenue to recognise given that I'm transferring control or my customer's receiving or the benefit over time? They are either input methods, so things like resources, perhaps labour hours, perhaps costs, might even be time elapsed, or output methods being actual surveys, actual number of sessions performed. So training organisation, for example, how many training sessions did you need to do under the contract? How many have you done? And recognise the revenue proportionally, those sort of things. So that's an output or milestone method type achieved. So again, we'll just reiterate that you need to select that method up front because that drives your recognition of revenue. And you need to select a method that is actually representative of the performance obligations being satisfied. So you may have an agreement to provide, let's go back to my number of training sessions. Let's say you've got an agreement to provide 12 training sessions over, and you're going to do that within the next year. In my view, it wouldn't be appropriate just to recognise the same amount of revenue every month over the period, and particularly if that's straddled a year end. What would be more appropriate is saying, well, how many training sessions have I done? I'll recognise that proportion. So as I fulfil my obligation of providing those training sessions, I recognise my revenue in accordance with that. So what are the real lessons that we've learned from AASB 15 and working with our clients in relation to the application of this standard? Well, first of all, you really need, the first one's about when do you have to do the work? And I would suggest that you really need to look at your contracts at inception or at the beginning of them. Picking up a contract at balance date, or worse, when the auditors turn up, is fraught with danger around what have you done and on what basis have you done it. So assess your contract, understand the performance obligations, understand how you're going to measure what you're going to peg your revenue recognition to within that contract. We would strongly suggest you document that. Simply having, just refer back to the agreement for what the performance obligations are means anytime someone wants to look at that, they're searching through that 50-page grant agreement or whatever agreement. Whereas if you list those performance obligations out somewhere, we suggest a matrix which perhaps contains all your revenue, all your contracts with customers. It could be an individual summary page on the front if you wanted to do it that way. Not too fussed how you do it, but actually doing it is the important thing. And then the third thing is you really need to understand what information you're going to need. So again, going back to my training course example, so you're running 12 training sessions, unless you have operational staff type reporting to you as to when these training sessions have occurred, in a finance team, you're not really going to know when to recognise the revenue. And so we've seen that this standard has meant that the information between, I'll call it operational staff and operational departments and finance departments has got to have increased and have got to become more consistent around that transfer of information to enable you to do revenue recognition. So they're the three key things and the three, I guess, key suggestions that we continue to have around AASB 15 application. I just want to make a quick segue into COVID. So we've seen a lot of amendments get agreed. Amendments occur and amendments agreed between government or funders under a contract or waivers of obligations come through both in the for-profit and not-for-profit space as a result of lockdowns, etc., and the inability of organisations to actually perform their obligations under agreement simply because of lockdowns. What do you need to do? So you need to consider the impact under the 5-step model. So you actually have to go back and reassess the amendment or the waiver and what does that mean for revenue recognition. And you also need to get some level of confirmation around the funder as to what that waiver means, or the funder, customer, wherever that funding has come from, understand what that waiver means and get that documented so you have certainty around, do you have repayment obligations because you haven't met all the obligations, and get certainty that that is not the case, particularly at year ends or as those agreements conclude. So this is an example of, and it's a cut down sort of contract register where we've said, well, put your various sources of funding into some sort of register or matrix, document out your performance obligations, how you recognise revenue and what the measurement basis is. This is a very cut down version, just as an example. We have an Excel one that has all the 5 steps, has ability to reconcile revenue at the end and all those sort of things as well. So if you want that, I'm going to put up George's email address at the end of this presentation. So if you're after that contract register, please let us know. We're happy to share it to help you work your way through AASB 15 or improve your practices around that. There is a couple of other things I just want to acknowledge. So I know where you've got these upfront fees, that requirement to spread it across a period of membership or period of schooling, those sort of things. We know you really don't like it. At the moment, we're stuck with it. I'm not sure the AASB, the Accounting Standards Board, has a whole lot of area to move on that. Certainly won't move for for-profits. Maybe in that smaller not-for-profit space, we might see some movement there. But yes, understand you don't like that requirement. And just a reminder around own use assets in the not-for-profit space. So where you get a grant, for example, to build a building. So if you're a school or you get a building that you're going to use for your own use, develop a website for your own use, where you have a capital asset in that case, you get to, in effect, defer revenue recognition and recognise revenue as you construct the asset. So I do note that the asset is capitalised on the balance sheet, the revenue goes through the P&L, so you don't get a matching concept, but you do get deferral when you haven't fulfilled your obligation to build your own asset. That's a small exemption within AASB 1058, just that I wanted to make you aware. I've seen some clients not aware of that one. So that's it for revenue. Again, I know that's a complex area. If you have questions, please throw them into the chat and the Q&A function, and Pete and Edward will try and answer specific questions, or if we're getting a similar theme, we'll come back to it and we'll address it in the group at the end. Just moving on to lease accounting. So again, lease accounting has been in a year. It really is a contentious standard between bringing what is an operating lease onto the balance sheet and really treat it like a borrowing. Understand that there's a number of entities who didn't adopt it, special purpose entities. Again, I'd suggest that if you're a not-for-profit under 3 million, I'd continue doing what you're doing until we get some clarity around tier 3. If you're a for-profit and you're large, I'm sorry, but next year you need to adopt, or I guess you could have a qualification in your audit around that, but you need to adopt lease accounting and AASB 16 next year if you haven't done so already. So it brings operating leases, including property leases, onto the balance sheet. I would note that leases of less than 12 months or low value leases, so things like laptops, there's an exemption for those. I would just point out that that low value asset test can be an asset by asset test. So you could have a lease for multiple laptops as an example. You get to assess that at a laptop by laptop assessment around low value. So it's a low value asset, not necessarily a low value lease. And so that enables you to use that exemption a bit more broadly than perhaps has been understood by some entities. The ongoing issue with AASB 16 is that it's not a set and forget calculation that you then just plug in the journals over the period of the lease. And there's a number of reasons for that. First one is the lease term. So if you have a lease with options in it, when you first do lease accounting, you've got to make an assessment as do you reasonably expect to exercise the option or not, or options or not. And at that point, you make that assessment and your lease calculation is therefore done on a term that may or may not include those options, depending on that, whether you're likely to exercise them or not. If you have moved through, things change over time. So for example, you've had a lot of lockdowns, your workforce now wants to work from home, you don't need that big office, you now decide you're less likely to exercise an option and you might look for something else. For example, you've now reassessed your lease term. At that point, you need to redo your lease calculation. The second component of that, you'll recall that there is an implicit interest rate within these calculations, or what's called an incremental borrowing rate. Where you change your lease term, you use a new rate. So you reassess that rate. Now, fortunately, I don't think rates have changed much in the last 12 months, haven't skyrocketed or anything, but there is a new assessment of what's the appropriate rate. If your lease contains CPI increases, so you don't know what that change is going to be every year, you need to do the recalculation of your lease liability as you understand what your CPI adjustment is. If you have fixed rate increases, obviously you can include them in the initial calculation. And so in effect, you don't have to do a change every year. I also would note that if the lessor has options, which is a little unusual, but if you have a lease with that, that's a bit more complex. An international body called IFRIC puts out guidance or really decisions on how to interpret standard in some unusual cases or where the standard really didn't address something specifically. And it basically says you ignore the fact that the lessor has an option and you only focus on your own. So that's something to be aware of. If you have that, happy to help you out on that type of lease or look at it specifically with you. So the question that arises is really how flexible is your model? If you're running a really basic, if you only have one lease, redoing a calculation, redoing the lease, it's probably not a big deal. If you have many leases though, and you have all these changes and issues going on, I'd suggest that running a lease for a single lease for a simple finance calculator, finance lease calculator, and trying to add them up and do the journals, etc., perhaps isn't the right model and isn't sophisticated or flexible enough. In relation to rent relief, again, there's some guidance that came out around rent relief, aware that a number of you would have got rent relief through the COVID period. If it's a typical rent relief where in effect you either got a period where you don't have to pay or you got in effect a deferral or part deferral, some guidance came out to say you don't have to redo all your lease calculations, new borrowing rate, etc. You just account for that lease modification in the current period. What does that mean? It means you reconcile your liability, being the discounted back remaining payments that you have, and the balance or any adjustment for that goes through the P&L. So for example, what does that practically look like? If you didn't have to pay rent for 3 months because you got rent relief, your expense or your expense or your rental payments will have been lower, and that will impact your P&L. It will almost be this negative expense in relation to your lease payments. You continue to amortize your right of use asset, but your interest expense will be less, and there's a forcing adjustment through the P&L to make sure your liability reconciles at balance date. I would just point out that do you need a more sophisticated model? If you do, our business advisory team helps some clients with this. So we've got maybe less than 10 or 20 leases. They can sort of manage the calculations, give you the journals for it if you're just confused by this whole area of accounting, and we can set up something for you. Likewise, if you've got a significant number of leases, we have a sophisticated model that we've used with some clients. One client's got about 3,000 leases in it and running it on that. So we can provide you with that model, training and support around that as well. If you're interested in that, please reach out to us. I am nearly finished, and then we'll do some questions, etc., and let you get back on with your day. So just want to touch on simplified disclosure standard. So you would have heard me talk about reduced disclosure before, so general purpose, reduced disclosure. It's leaving the building, if you like, and there's a new standard called the simplified disclosure standard coming in. What does it mean? It means all the simplified disclosures, or what was reduced disclosure, is going to be in one standard. That standard is 244 paragraphs. That sounds overwhelming. It is a little, but it is really well segregated by inventory, property, plant, and equipment, etc. So once you navigate around it, it's easy to find what you're looking for in relation to disclosures for particular transactions and balances. It's based on what's called IFRS for SMEs. This is the International SME accounting standard. Australia didn't adopt that, but we've picked up, in effect, the disclosures within there and put them in this simplified disclosure standard to more closely align with that, and then included a few Australian specific items. What does it mean? It means not a lot. If you have, there's a couple of back to the future moments, really. So if you have pretty simple equity section of your balance sheet, so really it only moves by retained earnings and not much else happens. you can remove that statement of change in equity and reconcile retained earnings or equity at the bottom of your profit and loss statement or statement of comprehensive income. That used to be done, removed when 101 all got changed, IFRS came in. So that is a possibility to remove statement of change in equity if people are interested in that. There's a few disclosures being removed, but they're not common. Certainly not common to the people I think would be on this call, so I haven't gone into details. And there's a few new disclosures, so things like lease maturity analysis, where you have to do it less than 1 year, 1 year to 2 years, 2 years to 5 years, that sort of thing. So that's back, as well as the continued disclosures around franking credits, audit fees, etc., which is some Australian specific disclosures, so they remain in the new standard. Last but not least, I just want to quickly touch on some areas that have been impacted by COVID, lockdowns, issues within certain industries, really. And I know we've come a long way over the last 12 months. There's far less uncertainty. We pretty much know what the government does every time there's a small outbreak or whatever in Australia. And so there's perhaps less concern around some of these areas than there was before, or they're perhaps more industry specific concerns as opposed to broad concerns across everybody. So where you have things like goodwill and intangibles on the balance sheet, impairment calculations really have to take into account, so your cash flows forecasts have to take into account the current environment and an expectation around the future environment. So clearly if you're in industries impacted by overseas students coming in, travel, training and events, those sort of things, we expect to see there's obviously continued disruption in those spaces. And so you need to think about that in those impairment calculations. Where you have financial instruments, so where you loan other people money, you have a large debtor book, particularly that has extended payment terms, things like that. The current environment has changed the credit risk of some organisations. That is the trigger now for whether you have impairment within those receivables, loans receivables, financial instrument receivables. I talked about leases and lease relief discounts and that sort of thing. Any other assets that you have recorded at fair value, really just a reminder, you have to reassess that fair value for changes. Fortunately, I don't think we've seen significant declines in property and those sort of things. So that is probably of less concern than sort of the unknown we were in 12 months ago. We're still seeing a lot of organisations with prepayments, payments in advance for events, travel, those sort of things floating around on the balance sheets. You really do need to understand what's the likelihood of you either using that credit or that prepayment, and does the entity you have that prepayment have the ability to actually either repay you or ensure that you can actually have that event, etc. So obviously the credit risk around those things just needs to be thought about. And then the overarching ones, which are always there, are going concern. If you've been significantly impacted, going concern can be impacted, and there's assessment you need to make around, can you continue to trade sustainably for at least the next 12 months? And also subsequent events. So as we know, this is ever changing. Things pop up out of nowhere and suddenly there's an impact on organisations where they're significant or material. There'll be specific subsequent event disclosures, but we're continuing to recommend and see some more generic disclosures around the uncertainty and how that could impact organisations, particularly where there is actually a potential financial impact, as opposed to where you're an entity that really has got through relatively unscathed, if you like, or it's pretty much been business as usual in your industry or sector. So that's most of the things. Again, Georgia can send you any of those templates or things that we've spoken about. At this point, I would just note that this is a pretty general update. If you have specific instances, specific contracts under 15, lease issues, etc., please reach out to us for specific advice. There's obviously often nuance in some of this, but this is at the high level. And other than that, really want to thank you for your attendance, and I'm going to try and stop sharing my screen and throw back to Peter, who will run us through some questions.
Thank you, Jeff, and thanks for the presentation. We've been answering questions busily in the background. I think we've got most of them, but I'll just comment on a couple of them. So a couple of questions in relation to the reporting thresholds. Again, just a reminder to those that the reporting thresholds for profits, the large company definition applies. It's a revenue test, an employee test, and a total asset test. Those tests are calculated in accordance with the accounting standards, including consolidation. So just be aware of that. For the ACNC, those tests at the moment are based on their existing thresholds, above 250 to $1 million for a medium company, $1 million and over for a large company. As Jeff said, those thresholds are currently being reviewed and we expect an update at some point. We expect they'll be lower than what was recommended in the original 2018 review, and most likely, as Jeff said, $1 million, $500,000, $500,000 will be the cut-in for financial reporting and assurance. So $500,000 to $3 million for a medium, above $3 million for a large, and there'll be the different obligations for those. So, but again, for the ACNC, they're calculated in accordance with the accounting standards, the revenue standard for the calculation of revenue. Some of the other comments were mainly around, do we get a copy of the slides? So we'll be making a copy of the slides available after the presentation. I know there's a lot to take in and a lot of it is technical. What comes very naturally to Jeff takes a little bit of time to absorb. So just a bit of a recap. So the reporting thresholds, we commented on that. The revenue and lease standard came in effectively for most organisations last year. So an opportunity to just have a look at your implementation, refine the processes, and move forward with greater clarity. Remember, the board will probably need educating as well. So we'd always recommend board papers on the application of those standards. And then the big news is probably the simplified disclosure, replacing what you would otherwise have known as reduced disclosure. And remember that if you go to note 1 of your financial reports, you'll generally see a comment describing the basis of your adoption, and it'll either say special purpose or general purpose reduced disclosure. And if they're general purpose reduced disclosure, as of next year, both for profits and not-for-profits, that will become the simplified disclosure. So there will be some work to be done around that and some decisions to be made. Apart from that, we're just over 1 o'clock. So if, and I can't see any more questions, there's a couple that have popped up here. Let me just see if we can answer a few of them. Okay, Jeff, can you go turn your share screen back on and put George's email address back up there for participants? So we'll just freeze the screen there, but we are sending a copy of the slides out, so that will come out to you as well. Just up one, Jeff, there we go, that one there. So georgia.humphreys@saywardawson.com.au. And as we said, we'll send you a copy of the presentation, and we're happy to send out any of the tools that we build. Again, we very much believe in supporting our clients and building tools that will help you do the work better that you need to do. So I think that was about all the questions. We're going to stay online a little bit and just answer some of the ones that are just popping up now. But I'd like to just thank Jeff for the presentation, Ed for answering most of the questions in the background. Hopefully the glitch there with the IT didn't affect you too much, and you were able to gather the content of the slides there. And just thank you for all taking the time to dial in. We appreciate it, and are here available to support as you need. So have a great day, and hopefully that was useful. But if you've got other questions, just email them through to Georgia, and we'll get back to you as soon as we can. So thank you. Have a great day. Thanks, Jeff. Thanks, Ed.